A big welcome to our live audience for Digital Health Investor Talk. I'm your host, Stephen Wardell. I'm the managing partner of Wardell Advisors, a digital health advisory firm, and the author of The Future of Digital Health. Wardell Advisors is helping digital health companies address issues around growth, fundraising, trade sales, and strategic alternatives, giving you more options in today's challenging environment. You can follow me on X at x.com/Stephen Wardell. Our show today is called The Good, the Bad, and the Ugly of AI in Healthcare. AI has limitations as well as superpowers, and we look at the places generative AI can be effective, but also where it fails. Our guest today is Razmi. Ron is a cardiologist and venture partner at Zoe Capital and the former CEO of Acupera. He's newly the author of the just published book, AI Doctor, The Rise of Artificial Intelligence in Healthcare. You can follow him on LinkedIn. This show is being recorded and will be included in my podcast series called the Digital Health Investor Talk Show. Subscribe to our podcast on Apple and Spotify. Note we have new show links as of recently. This is not investment advice, and we are not investment advisors. First off, here's the format. The show's 90 minutes long, and Ron and I will spend the first half talking about the news and the macro picture and things going on in digital health. And for the second half, we'll focus on our topic of the day, which is the good, the bad, and the ugly in AI in healthcare. And we'll be taking questions throughout in the LinkedIn chat. So, Ron, welcome to the show, and please introduce yourself to our audience.
Steve, nice to be here. Thanks for having me. I had mentioned in my LinkedIn post that this is one of the only podcasts that I make time for every week, and it's an honor to finally be on it as a guest. So as you mentioned, I started out my career as a cardiologist, thought I was going to be an interventional cardiologist, academic interventional cardiologist at the Mayo Clinic, and then a minute later, I got pulled into technology development. I was involved in developing the initial applications for cardiac MRI, and that ignited my interest to be on the technology development and the business side of healthcare. So I went back to business school and ended up at McKinsey for a number of years doing corporate finance. And I saw the digital health revolution coming in 2010, 2011. So started one of the first companies in this space to build population health management software. And we successfully commercialized that technology to the likes of Kaiser Permanente and Montefiore and so forth, and saw firsthand the challenges of bringing technology into healthcare and getting the data and workflow design and moving up the food chain to be a select vendor and so forth. So now we're on the investment side, and a lot of those lessons from having built a company and seen what it takes to bring digital health into the practice of healthcare or the research world in life sciences is very instructive. And I wrote this book to synthesize those learnings from the first decade and a half of digital health.
That's great. Thank you. And I've had a chance to browse through the book, and I really found a couple of things about your new book. The first is how thorough it was, looking at the different parts of medicine and where AI can play a role in very different parts of medicine and drug development. And the second was how business oriented it is. So I like that. My audience is a business audience. And the third is that you bring a kind of a skeptical tone, like you've seen a lot. You've seen a lot, including things that haven't worked, as you're trying to understand, where the value really lies. So I recommend the book AI Doctor. It came out this month. Is that right?
Yes. Wiley is the publisher, and actually it came out. The first copies went out in February, but really it's just ramping up now.
That's great. And our audience is the kind of audience that would read a book like this. So
and the coverage so far in the media, Newsweek did a very detailed article about the book, and beststocks.com and upcoming Fox Business and so forth. So the coverage reflects the content in the book, which is a business audience.
That's great. So let's go move on to our first topic, macro news. So unfortunately, it looks like it's a choppy week this week. So we have the NASDAQ at around 16.1 thousand, down a point today. And that's so. And I think the reason for this primarily is that there was a CPI report this morning, and it said for March the CPI was 3.5%. That was slightly higher than expected. But markets are very attuned to: are we going to have durable, lasting inflation, which is really bad news if we do. And so the CPI coming in even slightly higher than expected is bad news. And it caused the market to pull in a percent across a couple of indices, and it caused treasury yields to jump out of concern about the future. So, and what the next step is, it means that the markets are concerned that the Fed is going to go wobbly. So everyone was getting excited about the Fed cutting rates 3 times by the end of the year, probably 25 basis points each time, and that would be considered to be moderate expansionary behavior on the part of the Fed. And now people are frankly worried if the Fed is going to do this or not. And the Fed itself said in notes released this morning that it wants more confidence that CPI is moving toward the 2% target. So, leaving ambiguous whether we'll see 3 rate cuts by the end of the year. But I think in the short term, what it means in the minds of market makers is that it's not going to be anytime soon. We're not going to see the first rate cut in the next few weeks. So any thoughts on, and this is bad news for the innovation economy, because the innovation economy really doesn't want there to be inflation. And by innovation economy, I mean young company leaders and investors. And it really wants there to be both low interest rates and low inflation, which we had from 2009 to 2021. And so it looks like that's still a little bit out of reach. Investors in digital health have been sitting on the bleachers, is the expression that I use for it, due to uncertainty with high rates. And they really want to see rates pull in again before they start becoming more active. So we want to see those investors become more active in digital health companies. So Ron, any thoughts on this news?
Well, I mean, the concept of secular stagnation, which is been discussed as a cause of low inflation for 4 decades, since the early 1980s, was aging population, in industries switching to the type of industries where you don't need as much labor. Consequently, demand was lower, so you did not have inflation, and then all of a sudden it comes back, and it comes back with a vengeance. With the pandemic disruption, where you had loose fiscal policy, loose monetary policy, and supply chain issues all over the world. So if you look at inflation coming back down in Europe, in Japan, and so forth, we're actually ahead of the game. There are a lot of seismic drivers, because fiscal policy, there was trillions of dollars pumped into the economy, interest rate went to zero, and there was a major problem with supply chain. So each one of these, in and of themselves, could drive up inflation. And even though they're all getting cleaned up, it's going to take time. And if you look at what the definition of transitory inflation is historically, it's around 18 months. So it's not 3 months or 4 months. People think transitory inflation is only 6 months. So I think it's also been stickier because people still have money left over, and there have been some major government programs, such as the infrastructure project, the R&D, the CHIPS, and the Inflation Reduction Act, which is a climate bill, that's pumping money into the economy. So the aggregate demand hasn't subsided as much as you would expect with these rapid interest rate rises. So I think there are counteracting forces that are keeping up demand in light of these interest rates. The other thing to keep in mind is that what is the neutral rate for the economy? if you subtract the inflation reading from today from the actual Fed funds rate, you're looking at about a 2% real interest rate. 3.5 subtracted of 5.4% or whatever. It's about 2%. So the rate is not so restrictive if you take inflation into account. So I think the Fed is gonna be more careful because persistent inflation affects everybody, and that's bad news for the incumbent going into an election year. But this is how the cards are getting dealt in this cycle.
Yeah, thank you. And then I'm going to keep. I have a slightly more optimistic view on this than most. I think young company leaders and investors in the marketplace right now, which is that most I've spoken with think that the investment environment is tough right now and is not going to get better for the next 12 months. And I'm calling that we're going to see a significant uptick in number of deals later this year. And what I see for that is that I visited a bunch of investors in New York the other week, and they're saying that biotech fundraising is back. Well, that's an adjacent area to digital health, and that's great news, and that's going to be contagious and spread to digital health. They also pointed to stock market indices at near record highs, and they also pointed to the Reddit IPO, which is getting some excitement going around tech and big tech and IPOs again. And the Reddit IPO was up 90% at one point. I think it's still significantly up, but not 90% right now. So some positive news that's forward-looking, that's looking in now into April and Q2 and Q3. And I think we're going to see that spread to digital health, and we're going to see an increase in deals getting done in digital health where it's been frozen for quite a while. So, and for our audience, by the way, now's a great time to ask any questions about that you have in macro news or other trade journal news type questions of us. But any further thoughts, Ron, before we move on to industry reports?
Well, first of all, on digital health funding, I agree with you that I don't see it being dormant for another 12 months, maybe another 4 to 6 months. I do think there was, if you look at the first quarter report that just came out from Rock Health, the funding is around 2019 levels, which was way up over the previous decade. We went through a euphoric phase with cheap money in 2020 and 2021. I think comparing it to 2020 and 2021 is not really appropriate because interest rates were zero. There was a lot of liquidity, and investors were chasing deals, and they wrote big checks at high valuations, and those valuations have been chopped down dramatically. That means write-downs for GPs and LPs, which slows down writing new checks. So is digital health, the pace of deal flow or the dollar amounts appropriate or healthy? Compared to 2019, you could say, okay, it hasn't grown a lot over if you forget 2020 and 2021, but it's dramatically down from those years. So I think realistic valuations, a more discriminating set of investors who don't buy the hype about a company and its forecasts, that's probably what the space needs. And if it means less deals but at more appropriate valuations, I don't think that's bad for the field. I think the hype, the inflated valuations, and then write-downs is what's toxic for digital health, not slightly lower deal flow at more reasonable valuations.
Okay, thanks. Yeah, I think that's a great way to look at it. So now moving on to industry reports. And again, for our audience, you're welcome to ask us questions or even throw in your own report that you that you came across that you'd like a reaction to from us. So I think that the big news in terms of reports this week that our audience should know about is just that the Rock Health funding report came out looking at first quarter, and their numbers were 2.7 billion across 133 deals. To put that in context, as you said, this is funding at 2019 levels and way below the boom years of 2020, 2021, and 2022. I think overall, my impression of the Rock Health report was it was in line with what we've been hearing before the report came out. It was a little disappointing to me, and I'll go into why. Funding level at 2019 levels, but number of deals is up a little, and that in turn means that average deal size is down a little at about 20 million. And so there were certainly a lot of super deals being done back in the boom years, and so you'd think that average deal size would go down. Some of the findings that Rock Health itself called out were that in private markets there were a lot of creative financing measures, which were often resulted in what they call unlabeled rounds. So that's when a company is silent about raising a round or says, we raised 15 million, but then they don't tell you that it was a Series B. And you look at their record and their last round was a Series A. Well, why don't they say it was Series B? And the answer is that maybe their maturity level is not at a Series B yet, or maybe this was a bridge round of some sort, or they actually just want to be Series B ought to be 30 million, they think, and so it looks disappointing if you call it a Series B, but it's only 15 million, or issues like that. So companies being kind of quiet, but anyone who gets a deal done in this environment, that was tough, and they pulled off a big victory, a big win, and so I think they get credit whether they label it or not. Rock Health says AI drove the energy of the quarter, with 40% of deals claiming an AI element. That's interesting. That's bigger than I would have thought. And it shows you where things would be if we didn't have the AI super trend going on. And also, investors continue to demand outcomes and results, whereas in the past, they wanted to see high top line growth rates out into the future. But now they're demanding, clinical outcomes for customers, financial outcomes for customers, break-even results for themselves, etc. And then in public market, a very dismal trend that they call out, which is delistings in the public market. Oh goodness, this is the hangover part of the discation.
Well, some of those are not. Some of those are not even delisting. Those are companies that went out of business. I don't know why they're categorizing that as delisting.
Yeah, so Better Therapeutics was a bankruptcy and then delisting. Veradigm is going to the over-the-counter market from one of the major exchanges. Science 37, I'm not sure why there. So, but that's a very, it's a dismal trend, and it also creates a headline problem for the sector because there's investors who are excited about AI. They're excited about maybe consumer tech again. Maybe they're getting back into biotech, but they're avoiding digital health because every quarter we have more announcements of companies with big problems. Anyway, that's my report and my take on it. Ron, do you have any thoughts on this report or other reports? And for our audience, feel free to ask questions and throw your own report into the comments, and we'll remark on it.
Yeah, I mean, I would say that if investors are only starting now to ask for outcomes and economic stories for their investments, what have they been thinking about so far? I mean, I started my company back in 2010, 2011, and even back then we were thinking about we need to create white papers to show that we're improving blood pressure control and diabetes management and so forth. Companies like Omada that have survived have been focused on showing outcomes. And you have insurance companies, you have providers that have hundreds and thousands of digital health companies banging on their doors, including employers and they need to decide which few they're going to choose every year to invest their limited digital budget on. I mean, these tools, um, they're not going to stick around for very long if they're not showing any benefit, or if people are not using them on a regular basis. And part of the problem with digital health tools, especially consumer tools, has been they haven't been sticky enough. But also on the enterprise tools, I remember like Castlight Health, which is one of the companies that got delisted. Castlight Health came out with they went public for $1.5 billion valuation on $13 million revenue. And, that was a big multiple. And over time, I started hearing that even though the product was wonderful, the employees that were using it to find high quality providers that, provided value, there were good value for the buy for their money, were not using it after a while. They were going back to asking their neighbors or their golf buddies who to use to get their knee surgery done. So the problem of stickiness is real. And that might explain why some companies that create a lot of buzz uh, can't sustain it. But there's also another issue right now to keep in mind. I have been hearing for about a year that post-pandemic, when the economics of a lot of these provider institutions got turned upside down, they were starting to cancel some of their digital health products, some of the enterprise digital health subscriptions that they had signed up for prior to the pandemic. They decided to forego those and start focusing on getting patients back into their ambulatory surgery centers and their high margin service lines, focusing on those rather than investing in digital health. So that might explain some of the disappointing headlines that we're seeing in the space.
Mm-hmm. That's great. Thanks. So now moving on to business news, and trade journal news. So here, I'll just call out a disappointment. So this is recent news. The New York Stock Exchange has notified American Well that it's at risk of being delisted. I'm pretty sure this was not not one of the companies in the Rock Health report. And so here's another headline problem. And specifically, its shares need to consistently trade above $1, and they've been trading below $1.
Mm-hmm.
And Amwell announced an intention to do a reverse stock split to address the issue. And I looked, and the company has had declining revenue and still has negative earnings. And I think this has got to be related to the commoditization of basic telehealth. So there's telehealth visits like the kind that a company buys and pays for people to get primary care type visits cheaply and by video. And that seems to be commoditizing. That was the bread and butter of Teladoc and American Well. Then there's highly specialized telehealth where it fills a specific niche in a specific, acute medical problem. That's not being commoditized. There's still a lot of opportunity in that area. But the area that American Well had as its bread and butter seems to be commoditizing. And then I'll throw in some good news. So I see Blackbird Health has announced it's raised a Series A at $17 million. So this is Tom Peterson, who's a serial entrepreneur in the sector. And I think he did Conance before, which is a revenue cycle management company. And this is led by Define Ventures. That's Lynn O'Keefe, who was the former head of Kleiner Perkins for digital health, with participation from Frist Cressy. And they have a hybrid clinical model for youth mental health, and they're using the money to expand the states they're covering. So this is really interesting, and it represents another example of tech-enabled services, hybrid care, alternate care delivery models, entrepreneurs I call it wearing black turtlenecks, reinventing healthcare and clinics for users. Maybe users expect to get half their care out of their phone, for example, and the old system's not doing it for them, but the new system does, or the new system can supplement the time of a clinician with software, for example. So I really like this trend. It's part of tech-enabled services, which is a growing trend in digital health, where instead of selling software to care providers, you be the care provider. If care providers won't buy your software solution, how hard is it to be a primary care medical practice? Turns out it's not that hard.
If you have the providers, because there's such a provider shortage,
that,
clinician shortage across all levels.
yeah, that is a
Um,
very good point. Yeah.
yeah,
Um,
I would say I have something about this in the book, which is commercializing technology is hard. Getting to a yes, especially by provider institutions, takes a long time. And
mhm,
one of the things we noticed all the years that I was running Acupera was we successfully sold software to Ascension Health, the largest nonprofit health system in the country. I used to be a cardiologist for them, so I used my connections to land a mammoth contract for my company. But what we noticed is just selling them software, no matter how user friendly it is, they can't use it. They don't have the processes around doing care management or population health management. They don't have the staffing. And um, somebody told me if we did such a great job, this is from a different customer, with population health management, our ERs and our hospital beds would become less full. And that's not good for our business. So there's a schizophrenic business model going on where providers are being told to do value-based care, start doing proactive chronic disease management to lower costs, but they make their money by providing care to these people. If these people need less care, it means less revenues for them.
mhm,
So, figuring out a good business model, if you have a technology in healthcare, is not necessarily easy. Even what you're reading in the headlines of what United Health and Medicare uh, are saying, they want the world to go in a certain direction. That doesn't mean the providers are following those instructions. They're really looking at their bottom line, so they may do small populations of patients where they can show progress, they can show they're doing something about it, but they don't scale it up, or they may not be able to scale it up because it's really difficult to do population health management for a large patient population. So consequently, I think if you have technology, including AI is not immune to any of these trends. If anything, we've seen nobody buys AI just because it's called AI. It needs to solve a real problem. It needs to have show increased revenue or lower costs for the buyer. And if you don't have um, insurance reimbursement for it, which almost nobody does right now, I only know of a couple of examples that have secured codes, then it's a much tougher slug to get to sign customers because they have to figure out how to pay for it.
And we have a question from Weiwei in our audience. Why did Amwell's being selected as the platform for CVS virtual care not boost their valuation? What do you think of the primary care centers concept by those retail pharmacy giants like Walgreens and CVS? Well, for a long time, healthcare and medicine in America has been a cottage industry, which is that you have a primary care physician with a license to practice medicine, starts up a practice that's serving a new fast-growing suburb, for example, and that's your healthcare. And so I think it's inevitable that major companies like a Walgreens, a CVS, that have physical sites, something like 95% of Americans live within 15 miles of a CVS or Walgreens, so they have the site present, and they want to bring people physically in. And so as primary care is going to get, you have these convenience care centers and primary care centers being built adjacent to or part of CVS and Walgreens. And I think that's going to continue to grow. Walmart's doing the same thing. And that's a big threat to doctors, because doctors have a risk. They're not going to be able to run their own practice. They're going to be a non-essential employee of the Walmart Medical Center or something. So not necessarily great for doctors. It's great in terms of convenience and accessibility for patients, I think. So, and then why didn't Amwell stock, pop on having a deal with CVS? Not sure, but I'm guessing that kind of traffic is relatively low margin that they get through a channel from CVS, and so it wasn't enough to move their date of break even closer, or so. It may be the wrong kind of revenue. It's the kind of revenue that's commoditized. So, and by the way, I think it's very clever what they're often doing, which is they will staff these centers with a nurse practitioner who can take care of most things. But then if they need a doctor, then they dial in a video doctor. And so they don't need to have a doctor physically on premises to take care of a patient. But then they use Amwell as the back end for that kind of thing. So, Ron, any thoughts about that question?
This is another one when I may be a little bit of a contrarian on, because I have friends who have been involved in these enterprises at Walmart. And Walmart is also making a big play, and these are knowledgeable physician leaders who were recruited to massive salaries to come in and stand up these types of in-store clinics to take care of basic stuff. And they were not as optimistic as CVS and as the enterprise thinks putting a store in there is good because you grab a portion of the primary care market, but also you increase traffic in your stores, you're selling medications, you're selling over-the-counter stuff. But one of the things that I heard is the fact that so many people come in with problems that require x-rays and labs and that kind of thing. And then they need to be sent to an actual medical center where care starts from scratch. And, you can imagine if I have a problem right now and I need an x-ray and I go to Walmart and Walmart say, go to an urgent care center or go to an emergency room or call your PCP, I'm kind of starting over. I don't have much to take with me, only like a short history and physical, which doesn't mean anything. Anybody that you see is going to start the process over. So I think if they are if this is going to be a long-term play where people actually go to these facilities to get care, it's going to be a very small slice. Because if you're getting primary care, you're going to need screening tests. You're going to need cholesterol check. You're going to need to be referred for a colonoscopy. That in-store clinic probably has limited capabilities. And now for your colonoscopy, you're going to an actual medical center where you could have initiated your care with their primary care doctor who could quarterback all of your care, get your results back, tell you what your colonoscopy means, gives you your blood pressure medication, and follows you up, sends you for your eye exam and so forth. When you take part of that care and you say, okay, now go get this at CVS, I would imagine it's for things like vaccination or something really, really simple, maybe like a basic cold that doesn't require, because imagine even if you're 70 years old, you go in, you have a cough and it's slightly productive. The nurse practitioner at CVS may want to do an x-ray on you to make sure you don't have pneumonia. They may be concerned. Now they need to send you to a new place. So, I think this is work in progress. I'm not yet sold that in spite of all the money invested, in spite of all the acquisitions made, this is a long-term play. And as a matter of fact, I think some of these stores are getting shut down. I think I've read some headlines about Walgreens shutting down some of their clinics and so forth most recently. And I'm wondering if the rumors I hear through my network might have something to do with the realities they're facing as they're standing up these clinics.
That's great. Well, thank you. So I'm going to move on to just another news story in the news. So very interesting. An employee benefits platform called Beanstalk has been launched out of Redesign Health with seed funding of $7.5 million. So Redesign, they're acting as a venture studio and also as a seed stage venture fund. And this is with Matthew Sidney, who is a serial entrepreneur. I think he was part of the Viva team and then did another one after that. And this is in employee benefits. This is a platform that allows employees to choose their health benefits. This could be a wellness benefit or a care management benefit or other benefit from a selection of benefits in a marketplace instead of having the employer choose for them. This is really interesting for a number of reasons because I think this is a real innovation on what is normal for employees right now, which is that the benefit leader at the enterprise chooses the benefits for all the employees. And this is a painstaking manual process that results in 40 vendors chosen, each of which renews every 3 years and has to be renegotiated, et cetera. And many of which have salespeople who have banged the table for years to get paid for the special value that their product represents. And then along comes Beanstalk and says, hey, in every category, we'll have a bunch of selections and just let your employees choose. And so, this has the potential to be more attractive to the buyer. And it has the potential to contribute to a kind of an increasing need for suites on the part of vendors who are playing in this sector. And if you're not a suite, you have to be part of somebody else's suite. And also to possible what I'm going to call value collapse, which is that instead of paying full price for 50 different point solution vendors, the employer is going to say, I just want to go with something easier where my employees can choose in a marketplace, and that has the potential to upset the very careful pricing that's been fought for and won in this area. So I see this is a big sector, and I see this company as having real differentiation. They can potentially go in and sell to those employers, a real innovation coming out of Redesign Health in this. So I'm really intrigued to see what's going on with Beanstalk. Ron, any thoughts on this, or do you have any of your own stories you want to bring to the audience?
Yeah, I mean, I think you mentioned the fatigue of dealing with these vendors coming in, on-site clinics or exercise reward programs and all kinds of stuff for employees, and of course, with labor participation rates, 62, 63%. I mean, that's increasing. Fortunately, more people are coming back into the workforce, but it's been at a low level. I think there are 11 million jobs unfilled across the country. A lot of that requires reskilling of employees looking for work. So attracting employees, giving them good benefits and so forth, it's kind of been the name of the game since after World War II. But I feel like we're entering into another sort of nuclear escalation phase with economic growth being as robust as it's been. Surprisingly, probably explains part of the fact that inflation is sticky. It's because our growth rates haven't really subsided in spite of the high interest rates. So I'd be, for something like this, I'd be curious to see how the price negotiation happens, because part of sort of having a curated network is negotiating fees up front. So if you're selling me this benefit and I'm buying it from you for my benefits group, I need a special price. So that's where I would want to double click to see how they're negotiating price. Are they offering a marketplace? And to get on their marketplace, you need to provide discount to special customers, that kind of thing. But I would say that's a space that is in desperate need of innovation and simplification. If you can bring a basket to an employer and said, this takes care of 50% of your needs, I think that makes it very attractive. So in that sense, I think if they're making one sale and they're saying, instead of you looking at 100 vendors, just look at us, we'll bring you a curated list of benefits, and it's everybody pick their own, that could be very attractive. The simplification of life for a benefit buyer at an employer.
That's great, thanks. So, and for our audience, any stories in the press you want to call out for us to comment on? And I'm going to skip on to our inflection points discussion. So this is a new section of the show, and this show is about the future, and it's for innovators. And so innovators should be tracking inflection points in the market, because inflection points are what fundamentally drives new businesses. So an example of an inflection point would be smartphones with big screens going from 10% of users to over 50% of users. That the one is before the inflection point, one is after the inflection point. And so we want to spot and call to the attention of our audience inflection points. And there's room to disagree about whether an inflection point will happen and where we are in the inflection point. So I'm going to call out a couple here. And the first is that so pharma clinical leaders have big budgets, but they're very conservative. And for years, the way they built a clinical trial was simply doing it the way the last successful clinical trial was done. That was the plan. And by the time the world knew of these secret plans to do a clinical trial, they'd written the documents. They weren't changing them for your new technology or whatever. And I think with COVID, that was blown up. And pharma clinical leaders faced the bizarre situation of clinical trial sites being contagion points. And so they couldn't use them anymore. They had to run clinical trials. They couldn't use them. And so there was this opening for decentralization technology, automation technology, and having the subject do measurements at home instead of necessarily at a central clinical trial site, for example. And so here, I'd say we are post-inflection point on this. I'd say this has gone from under 10% adoption to over 50% adoption in clinical trials. And there's greater emphasis than ever at pharma for reducing unnecessary delays in clinical trials. And that means that they will be spending money. They're feeling spendy, they have cash, and they will spend money on decentralization technology in order to avoid delays, to get patients into the trial, get the data collected, etc. So that's the first inflection point. We're now post-inflection point on pharma clinical budget spending on decentralization technology. Any thoughts on that, Ron?
Yeah, I think your observation that just like telehealth, you needed a catalyst to push this to the forefront. Decentralized clinical trials benefited from the pandemic. One of the things about some of these innovations where you're like, why does it take a pandemic for them to start using it? Because decentralization could save costs, could expedite the trials and so forth. The thing to understand about especially providers, healthcare institutions, but also life science companies is you're usually dealing with pretty lean organizations where everybody's trying to get through their days and do what needs to be done. Change management is hard, and especially if it doesn't result in a lot of automation and work savings. Like one of the things has been the technology of aggregate real world data, using it to find patients for clinical trials, and using AI to look at notes to figure out which patients might be appropriate and meet the selection criteria. This, in my conversations, when I've advised pharma companies, they've always thought that this was going to be saving staff for them, that they would need less staff. And it's exactly the opposite. If the AI is doing a good job to find you more patients, that's an initial screen. Now you need human screeners to go read the charts and figure out if AI did a good job and found the right patients. And if AI is doing a good job and finding these patients, you need more people to recruit them. So once they see that they actually need to hire more people and so forth, their appetite for using the technology goes down. So if decentralization and doing remote trials has reached that point where they see the tangible benefit to trial timelines and cost savings, I would say L'chaim.
That's great. And for our audience, maybe you're seeing some inflection points and are wondering if we're pre-inflection or post-inflection. And for time reasons, we got to jump forward. So I'm actually going to skip to our conferences section. So Dipti in our audience asks a question. Speaking of clinical trials, interested in the relationship between AI and insurance coverage. As a founder dealing in the healthcare innovation and AI space, my main concern, do you see many investors contributing toward clinical trials? Are these trials the solution to get insurance companies on board? I'm not sure. So Dipti, I would say that in general, Wall Street investors are very enthusiastic about clinical trials for new molecular entities for unmet medical needs that will have a long, strong patent life and the potential to charge very high prices and cure the sick as well. And that is a very dynamic market that ran into some trouble in the last 2 years and is coming roaring back. So Wall Street investors like clinical trials in general. Now,
I think the question is referring to the AI space and clinical trials. And one question is, if you're going to bring me AI and you're telling me to use it in reading radiology scans or managing patients in the ICU, where's your evidence that this is going to improve my accuracy or my speed and consequently lead to better patient outcomes? So a few years ago, I was asked by New England Journal of Medicine to advise them on whether they should launch an AI in medicine journal. And that journal is on its way out soon. However, in the few months that I spent on that project assessing whether that was a good idea or not, I spoke with a lot of providers. I spoke with a lot of payers. One of the things I heard from payers was we're already seeing a lot of AI solutions that are getting FDA clearance to be marketed. And a lot of that is on thin retrospective trials. So I took 500 CT scans and I can show that my algorithm is as good as a radiologist in finding lesions in the brain or the liver and so forth. So question is, why would I pay for this? I don't know if this improves patient outcomes. And if it's being used as a productivity tool by the provider to make the radiologist faster and more efficient, there's no benefit accruing to me. I'm not going to pay for it. So I think the answer to our question is, if you want reimbursement from an insurance company, you're going to need to do exactly the trials that Steve just talked about for molecules, for AI, to show in the real world that you're improving patient outcomes. And that's evidence you could go to an insurance company and say, I want to be reimbursed. And it's going to make the sales process a lot easier to providers.
Yeah, thank you. And Patrina remarks that that she's seeing investors not funding clinical trials, and so for tech forward companies are not getting access to grant funds for clinical trials also, and it's holding digital health back. And I'll just mention that there's like two big categories of investors in all of digital health. And one of them are what I call software investors, and the other are FDA risk investors who like FDA risk. And software investors, the joke is that they can't spell FDA. And they have trouble with investing money in a revenue zero company that needs clinical trials before it can have a viable product. And then there's within FDA risk, There is a big, rich, spendy category of new biotech investors, and then there's a very small, not very rich category of medtech investors. And that's the group you're going after in general with digital health, is you're going after like software as a medical device seeking medtech investors. And that group we're in an investment downturn right now, and that has been as strongly hit as any other category in the investment downturn is the medtech sector. So it's been tough out there. I did see some funding announcements recently for medtech companies the last couple of weeks, breaking a gap in that. So that's good news. And I do think things are looking up in the future. We're through the darkest of the night.
Let me quickly mention that the comment is absolutely right on, that a lot of VCs put money into health AI companies, not realizing that these real world clinical trials would be needed to gain adoption and reimbursement. And they haven't been willing to then step up and put more money in to fund these clinical trials. And frankly, a lot of people who started these companies are data scientists, PhDs, who don't know how to do clinical trials, don't understand the process of bringing these types of solutions into healthcare. So you mentioned the categories of investors. I actually say when I was funding Acupera, I raised money from family offices in New York. I raised money from blue chip Silicon Valley investors. Neither one of them could separate the Acupera population health management software from a doorknob. They had no idea what they were investing in. And 10, 15 years later, it's not that much better in terms of investors, because you have your tech investors. And I would say I would lump the other people you mentioned into life science investors, people who have invested in biotech, medical devices, and so forth, which these two groups, by virtue of adjacency, they migrated into this intersection of digital and healthcare, and by de facto became digital health investors. But neither side, one side didn't understand healthcare, one side didn't understand digital technologies. So I would say we're part of one of the first batch of ex operators who have started investment firms directly based on our experience of running digital health companies and having been in that intersection and seeing all the barriers that you need to navigate around. And a lot of that is in the book. That's where I thought I could help with the gap in the literature, is talking about barriers in bringing digital technologies into healthcare and getting it funded and dealing with regulatory issues, long sales cycles, implementation issues. Any of that stuff could derail the process. But the point that was brought up around the need for clinical trials for digital health tools in order to gain adoption, and as a part of that, getting reimbursement, because somebody has to pay for it. And this has been something that has slowed down adoption of these technologies and continues to do so. And investors have not been willing to step up and put additional money in to fund these trials. And if we've learned anything from the first 15 years of digital health, is the buyers and users are immovable objects. Unless you give them what they want, they're not going to use your tool. People in the healthcare industry are getting up every morning, going and doing their job the way they've always done. None of them are on their knees begging for innovation. As a matter of fact, when innovation has been brought to them in the form of electronic health records, it's really made their lives more miserable. So the bar is high.
Well, thank you. And so now let's move on again. Just for time reasons, we're skipping some of our sections here to personal notices. So here, coming up for Boston members of our audience, I'm hosting an innovation night tomorrow night, Thursday, April 11th at the Liberty Hotel bar in downtown Boston, 5:30 to 8:30. And our guest is Sean Cheng, an investor at Ascension Ventures, and he'll be speaking on the topic of the roles that AI will play in the hospital. So if you're in the innovation economy, come on by Boston tomorrow. We're hanging out at the Liberty Hotel bar. I'll see you there. And you can register in advance, please, at stephenwardell.eventbrite.com. That has all my shows and parties. And then also, for those of you who are heading to Boston for BioIT World Conference, I'm holding a reception there on Wednesday, April 17th from 4:30 to 7:30 at the Crescendo Bar in the the Boston Omni Hotel, which is the hotel of BioIT World. And I'm very pleased to make the world announcement tonight that our guest of honor speaker at our reception will be none other than Ron Razmi, the author of The AI Doctor. Thank you, Ron. Ron is road tripping to Boston for BioIT World and for our reception, and also for his book launch party, which is going on the same week in Boston as well. So I encourage, and for those of you who want to actually attend the BioIT World Conference, my show has a discount code. I'm going the third day, Wednesday, of the BioIT Conference, Wednesday, April 17th. It's a 3-day conference. It focuses on pharma tech for drug discovery, the earliest stages, so software for drug discovery. And you can get a 15% discount on that conference with the code IVP Social 1524, IVP Social 1524 if you want to go to that conference, and then sign up for my reception separately at stephenwardell.eventbrite.com. So Ron, obviously you have a public appearance, which is you're at my reception next week, April 17th in Boston, but any other personal notices or public appearances you want to mention to the audience where they can catch you?
Yeah, thank you for that opportunity. Actually, when you have a brand new book out, your calendar gets filled up quickly. So next Tuesday, the 16th, Foreign Press Association is hosting a book launch event for me, and it's in Midtown Manhattan. And the president of the FBA is going to be interviewing me about what AI is going to do for the health of the world population and implications for the economy and our healthcare expenditure moving forward and so forth. Then off to Boston for your event on the 17th, the reception. The next night, there's a reception at MIT, which is another book signing. And Professor Zolovitz, who wrote the foreword for my book, he's at MIT, is going to do a fireside chat with me about the book. And he was instrumental in teaching me data science, and he was on the board of my last company and was kind enough to write the foreword for the book. He's been working on AI, medical AI, for 50 years. And then right after, the next day, I fly out to the Middle East to speak at conferences in Bahrain, Saudi Arabia, and then a few weeks after that, China, as part of the my world book tour. So lots coming up. People in Boston or New York next week, if they're interested in these events, I can put them in the chat area, the links to attend those events. They're private events, but we will try to approve as many people as we can for those events. And fortunately, Steve is going to be at the MIT event, so that's going to be great.
Yeah, thank you. Well, so now we're going to move into the second half of our show, which is the good, the bad, the ugly of AI in healthcare. And so, Ron, could you just kick it off by telling us the potential of AI in healthcare? And this is part of what your book was about. And your book talks about things like diagnosis and care and even drug development as well. But what is there's different kinds of AI. There's the full of excitement about generative AI right now, but before that there was computer vision AI and other kinds of AI. So could you just tell us about the potential, different parts of medicine and the potential of AI in those different parts of medicine?
Yes. So AI is an umbrella term. I would say the arbitrary branching would be machine learning and natural language processing. But now most natural language processing is powered by machine learning, and deep learning being under the taxonomy of machine learning. But to make it really easy, because we have limited time and I don't want to get technical here, if you have structured data like images are now digitized and it's all structured data, you can train a machine learning algorithm to read a CAT scan or X-ray or MRI. And this is an area that's at the forefront of the applications of AI in healthcare, just because the data is digitized and structured. And if somebody comes in with a stroke, Viz.ai, which is one of the companies that actually has gained some traction, could immediately run an algorithm on a scan that's tagged as being done for an acute stroke, figure out if there are signs of stroke, and immediately alert the radiologist and the interventional neurology team to prioritize that patient. And if you're in the midst of an acute stroke, getting you care minutes, hours earlier could really save your life, or they can restore blood flow, which keeps you from becoming paralyzed and unable to speak and so forth. So that's an example of straightforward training an algorithm to do what human would do, but do it without exhaustion, without distraction, and do it on demand much faster. And actually Viz.ai, because they were showing improved patient outcomes from this faster care, they were able to get a code and reimbursement. So if you can show outcomes, if you bother creating evidence for your solution, you can actually get paid for it. Then there is the more challenging things, such as I take all of the patient record, analyze it, and figure out what's wrong with them. That's sort of the clinical decision support, which is very difficult to do. It's not in the near term or midterm horizon, mainly because the data is in different places, sitting in different EHRs, unstructured. A lot of it is unstructured in narrative format. And it's not just that it's a narrative format, because now with large language models, our capabilities to do natural language processing is increased dramatically. However, when I was a practicing physician and I was seeing my patients, I never wrote a complete sentence. It's full of acronyms and your own abbreviations and so forth. So that, so the data is in a very weird format. A lot of it is incomplete, full of gaps. So that type of the nirvana of AI running on all of your data and figuring out what's about to happen 2 decades later and alerting everybody to take action now, that's decades off. What I'm interested in are low risk use cases, for example, clinical documentation, administrative workflows, coding, AI-enabled coding, prior authorization, claims processing. I know there's fear in this group, especially with Steve, about attack on humanity from RCM AI. But notwithstanding that grave threat to all of us that Larry Ellison is going to unleash any day, I think those are low risk use cases that can show some benefit to the medical centers, to the providers. If I'm a provider and you're saving me documentation, I would say I will kiss your forehead, because that's a big problem for providers. So even if you're not curing cancer with AI immediately, if you can show workflow benefits, bottom line benefits to some of these buyers and users, you're going to generate interest from this community that AI is not just hype and a buzzword, and they can actually see some benefits for their businesses and their daily lives. And therefore, they become more receptive to the future clinical applications and its use. But I would say the future, very optimistic about what AI can do in healthcare. The challenge is finding use cases today that can show some benefit and generate momentum for the space. I don't know if that helps, but that's a very simplified overview.
That's great. If you were to summarize the kinds of AI, I think we've mentioned three:
Mm-hmm.
machine learning,
Mm-hmm.
natural language processing, and computer vision.
Mm-hmm.
Are those three distinct? Are there other kinds that are that we've missed so far?
They're not distinct. Computer vision is a form of machine learning.
Okay.
So, a natural language processing now is deep learning, like the large language models,
Mm-hmm.
which are now the basis of our NLP engines, are deep learning based. So it's not a clean taxonomy, but sometimes I try to simplify things, and I've been attacked when I've sat on a panel by AI purists by separating natural language processing from machine learning. So I try to be careful with what I say. Um, but generally, I would say um, if you think about structured data, which is all the data is structured like an image, that's pure machine learning algorithm that's going to look at an image and tell you what's going on, including pathology, digital pathology, or dermatology lesions and so forth. That's a pure machine learning. With natural language processing, it's more complicated because it's not just about finding patterns, but you also need to find meaning in the written or spoken language. And that's been the more challenging part in healthcare, given that 80% of the data in healthcare is unstructured, and that's where large language models have recently resulted in a huge leap up in capabilities. So we're optimistic in these large language models finally uh, breaking open some things that we've been waiting for, including clinical documentation. That clinical documentation may not sound sexy enough for some people, but I think if you can listen to the conversation between a nurse, a patient, a doctor, and a patient and do the documentation for them so they don't need to type, that's a really good use case given the manpower shortage, how burned out everybody is. That's a great use case where people could see benefit from AI and actually like it rather than being worried that it's going to affect their jobs and their income when AI takes hold.
So your book surveys medicine and shows where AI can be used. What were some of the drivers of rapid adoption of AI and that you found, and what are some of the barriers to
Yeah.
adoption of
So I have a chapter for each one of those topics in the book, the drivers and the barriers. So let's start with barriers because there are a lot more of them. The main barrier that got its own chapter is the data and the fact that data in healthcare is very fragmented. It comes in many different forms. You have labs, you have clinical notes, you have genetic data that's increasingly being used. And a lot of this stuff actually sits in different places. Like even if you go to an academic medical center, certain labs, they send it out to a different outside lab to do. And that means when they get that back, it's not a structured data element in their electronic health record. It could be a PDF that they're getting back. Now, one of the things that I've always said as a physician is something that non-physicians and not people who are not from healthcare may not appreciate, which is in healthcare, one piece of data could change the entire picture for someone. If I have all of your data from your entire life till yesterday, but yesterday you were an outside institution and you had something, you had a lab work and it showed your kidney function has had rapid deterioration and your creatinine went from point A to now being 5, you are a completely different person now. So that one piece of information completely impacts how I can manage you, what medication I need to give you, what additional diagnostic steps I need to take. So if you think about that, unless you have a master database that has all of your data in it, running algorithms on your incomplete data is risky because we don't know what we don't know. We don't know what exists out there that can affect the picture. So I would say data barriers uh, are is the main barrier, and it's going to be with us for a long time unless there's policy at the national level where we have all of everybody has a unique identifier, no matter where you get care, that or anything you get done health wise, it all dumps into one place. There are other barriers. There's the fact that medical centers don't have knowledgeable people who know how to evaluate these tools and select the best ones, and then audit these algorithms for safety and keep an eye on them to make sure there is no model drift and so forth. There's ambiguous regulatory policy that affects entrepreneurs and developers. There are medical legal issues. Who does the liability lie with if an algorithm makes a mistake and damages not a few patients, but thousands of patients, potentially even millions of patients? Those are barriers. The drivers are the fact that we're significantly have shortage of resources. We need to provide care to an aging population. And if you have a technology that can address some of this mismatch between demand and supply, no doubt there's going to be interest in utilizing it to provide timely care, high quality care to people. And AI could definitely assist in many areas in that regard. There's been increasing investment. That's a driver. Uh, FDA has issued some policy papers in the last year that are providing more clarity about what they're looking for in these devices. So one huge barrier, which is the data issue, which is the data issues, and then some sort of mid-level drivers and barriers that are sort of moving in the opposite direction.
You mentioned how a lack of skilled, trained, certified people is actually a driver of AI. And I talk to investors about that same topic. And the way I put it is that if we had, is that the disease burden in society is so great, and the lack of skilled professionals is also great, and there's a big gap, and it's only going to get bigger. If we had a crash course to train more people in healthcare around the world today, it still wouldn't be enough for what's coming in terms of an aging society with a higher disease burden. And the only thing that there is that can fill that gap between skilled people on the one hand and the disease burden on the other hand is software to automate, software to assist with decision making. And so I see a bright future for all kinds of software in healthcare, including AI. So we had, before this call, we heard a remark from someone, Dinesh, about AI. And I want to get, your thoughts on this. So at one end of the spectrum, there's someone saying business as usual. And the remark was AI is only AI for the next 2 years, and then it just becomes software. And I'm interpreting that to mean that AI is just a small add-on to existing software that focuses on databases and workflow automation and that sort of thing. But then separately, we've also heard people remark that AI is our last invention. It's the last time humans invent anything, because all inventions in the future will be AI inventions, and it's the first time we've ever had an intelligence greater than our own on this planet, and that's a big deal. And so, where on this spectrum of AI is sort of a fad versus AI is our last invention, do you lie?
Yeah. Well, I mean, definitely not on either of those ends. I think, first of all, because of the issues we talked about in terms of having good data to train models, having good data feeding into these models once they are implemented in the real world, whether it's in drug discovery or development or medical devices or in the practice of medicine, I think AI is not just going to blend into software in the short term. Developing AI, creating evidence for it, making sure it works in the real world is going to be a heavy lift, I would imagine, for a couple of decades to come, just because the data is in such bad shape and healthcare is complicated that you need to generate evidence for your solutions. In terms of one of the things I mentioned in the Newsweek article that came out about the book was the fact that a lot of the things, the idealistic things that we look forward to coming out of AI in healthcare is going to take a couple of decades to materialize, including new therapies that we're going to find, new diagnostics and therapeutics that we're going to find using AI. We see a lot of money has been plowed into drug discovery companies, and some of them no longer exist. Some of them have gone public and their market cap is down 95%. That's because investors underestimated the effort required. Once you actually find a promising compound, you still need to take it through a wet lab, put it through preclinical stuff to make sure it actually, what AI found is real. And then you have to take it through clinical trials. So all of this is going to take time. And it's going to be a combination of human brain, general intelligence, ability to calculate the cost of making a mistake, which AI definitely cannot do, combined with superpowers of a model that's been trained to do one thing and do it better than human and do it consistently. So that's the future that I see. And in a few decades, I think AI can take over a lot of the things that we're doing manually now in healthcare.
Very interesting. That's great. And for our audience, now is the time to get in any last minute questions for Ron. And then where do you see the opportunity for an entrepreneur? So assume that our audience is about half entrepreneurs, to make money in AI in the future. Realistically, they're not tackling an impossible goal. The timing is right. And so two that we've mentioned, maybe three we've mentioned on this call, there is computer vision of medical imaging, and that's been around for quite a while. You might even call that, maybe I'd call that mature. But then there is claims management. And so it's a very manual process today, full of errors. Mm-hmm. And so just making it more automated, reducing the errors, that's intriguing, a lot of attention in that area. And then also medical scribing. You seem to kind of endorse the claims management on the revenue cycle management side, and then also the medical scribing on the clinical side. But what do you think of those for entrepreneurs on this call? And then any other areas where you see it's realistic someone could start a company today, they're not late, it's not an impossible goal?
Yeah. I have a chapter in the book titled How to Build and Invest in the Best Health AI Companies. So that's for entrepreneurs and investors. And I lay out a framework, a set of questions for them to ask themselves before they build something or they invest in something. And first of all, I would say the entrepreneurial opportunities in this space are untapped and unlimited. Yes, there have been a lot of companies, especially in radiology, because of sort of the lower barriers to entry. But one of the interesting things for the 3 years that I was writing the book, the success stories that I had in there around Babylon and um, uh, you know, Olive and so forth. Interestingly enough, those companies no longer exist. They became multi-billion-dollar unicorns that did not have sustainable business models. So I would say there is no area in healthcare where you could see um, this is a saturated field. Even if, like imaging, we know AI is very good with imaging. There are not a lot of big companies that are doing AI imaging, and they're now unicorns, and they're grab 80% market share or anything like that. So the opportunities to do business model innovation within imaging, for example, I talk about this in the book, having a teleradiology company that uses AI to read these images faster, and then you're providing services to hospitals that don't have as many radiologists as they need, and you can do it after hours on weekends and so forth. So AI could become a tool for you to provide services to hospitals, like you mentioned, tech-enabled services rather than selling the technology to the medical center. I discussed that in the chapter. But also, I was hosting a roundtable discussion at the Wall Street Journal Health Forum in Boston in February, and one of the people there was Vinod Khosla's son, who runs a company that uses AI to do care management. So instead of selling care management software to medical centers, they were taking on the process. They had their own providers, but they were selling that to provider institutions, saying, we can take care of these patients for you. And then they were using AI to improve their unit economics. So that's an example of a business model innovation where you have your IP, which is an AI solution, which makes your staff more efficient and helps you provide services with better unit economics. So if you're asking me, are there opportunities for entrepreneurs in this space? I would say unlimited, and it's going to be around for the next couple of decades at least. Plenty of things to do. However, it's not just walk in and take all. You do have to think through whether the problem that you're solving is mission critical, so your customer will actually want to spend money on solving that problem. Are you going to have the needed data when you go live in the real world when you're in production? Are you going to have all the data that your system needs feeding into your model real time so it can do what it needs to do at the appropriate moment in clinical care or in research? um, how is it going to be paid for? How are you going to generate evidence? How are you going to stand out from the crowd? So um, every area you touch, there are going to be opportunities, but you have to figure out a good business model. You have to think through these barriers and solve for them up front, so you don't create something for which there's not enough demand, or there's no reimbursement, or you don't have a way to fund the studies that show the benefit of your system. And early in the talk, you mentioned in the Rock Health report the comment around the fact that there's emphasis now on showing outcomes and benefits and so forth. Look, it should have been the case all along, and I can guarantee you it's the case with AI, that you're going to need to show those benefits if you're going to gain traction in the marketplace.
So from Juby, we have a question about reducing denials and claim rejection. So do you think generative AI could be used to build a competitive product to reduce denials and reduce claims rejections?
Yes, I mean this is one of those epic battles, like maybe Larry Ellison versus I don't know who would be his equal, Elon Musk coming in.
United CEO or
Yeah, exactly. Because when I was a physician, I was on the provider side, and one of the fun things that happens in the U.S. healthcare system is the negotiation annually between provider institutions and payers about rates that they're going to pay for different services, surgeries, CT scans, and MRI. And it's one of the things, if you've been a healthcare insider, that informs you that these guys could never be friends. They could never be on the same side because they have secret information about the other one or about their own business they can't share with the other side because they're negotiating on rates. It's a zero sum game. So, with that in mind, we're reading stories now that claims are being rejected because AI is being used to process these claims and rejection rates have gone up. So, that argues against the fact that AI could help providers lower rejection rates and get paid faster. So I don't have an answer right now on uh, this Elon Musk versus Larry Ellison scenario where providers are providing much better claims with all the information curated using generative AI that submits a better claim and it makes it harder for the other side to reject. Or the other side has better AI that can parse through all the submitted information and find one little thing wrong with it, which a human might have been less likely to find. We don't know where this is going to land, but I think this is going to be to the benefit of the provider, and I'm not just saying that because I come from the provider side. I think the heavy lifting is curating the information you're submitting, and it's a lot of work of here's what the imaging report showed. Here's what the labs showed. Here's what the doctor says in their note, and the note indicates how much pain patient was having and so forth to approve an injection in your back or a back surgery. If you have technology that can quickly pull all of this together, you're eliminating a lot of manual work. And you know, the guidelines are the guidelines. If your X-ray is showing something, if your pain level is high, if your labs are showing something, then legally the payer needs to respect that. But I can't say for sure that's how it's going to play out.
so I think NVIDIA wins, and that all of those chips that are being built now are going to be earmarked for the epic payer versus provider uh, AI supported reimbursement battle. So let's see. Roland just asked if you could talk about the importance of business model, and I would just say what would be like a winner or a loser business model, and also how to validate your business model in the healthcare space early for the entrepreneurs in the audience.
Yeah, so I mean, a bad business model is thinking that you can bring a clinical decision support for oncology that can help oncologists make better decisions on how to take care of their patients. This has been tried by the likes of IBM, and they were tossed out of Sloan Kettering. They were tossed out of MD Anderson. They came in with these lofty promises with IBM Watson, and it never materialized. And the issues were the fragmented data, but also if you think about an oncologist who treats lung cancer, I mean, they have a few options that they could use, and it's usually based on the stage and so forth. It's not a million options. It's really difficult to improve their accuracy and so forth. I know in smaller hospitals, there's not as much expertise, and there could be benefits and so forth for this. I'm not um, underestimating the benefit of AI in those situations. But generally, this is not a dying need at a medical center where they would spend a lot of money, and the value provided is not going to be massive. So that's a bad business model that doesn't take into account data issues and the benefit provider to the user and the buyer and so forth. A good business model could be finding a way to improve operations in a hospital. Like there's a company called Lean Toss. They have an AI solution that improves utilization of surgical ORs in hospitals, room turnovers, and so forth. So immediate benefit, immediate impact on the bottom line for the hospitals. You're not dealing with patient clinical information, so much easier. You don't need regulatory approval, and if you get something wrong, nothing really bad happens. So the medical legal liability issues are not a concern. And they've been very disciplined of staying on the operational side of healthcare and not touching anything clinical. So they focused on something that can immediately improve the bottom line for their customers. They're staying on the low risk side of things. Efficient use of operating rooms, improving the turnover of rooms, like the actual med surge beds in the hospital wards, can improve traffic and operations in the hospital. So they've focused on real bread and butter issues and applied AI to a problem like that. That's a good place. It's a good business model for right now. While a lot of these other issues are getting sorted out from the regulatory reimbursement perspective.
That's great. Well, thank you, Roland, for that question, and thank you, Ron, for coming in for our show today.
Thank you for having me. It's been an honor.
Thanks, Will. You've been listening to Digital Health Investor Talk with host Stephen Wardell, and our thanks to our guest, Ron Razmi. Our next show is Wednesday, April 24th at 4. The topic is how to prepare for the next fundraise with guest Michael Kish. And for our Boston audience, I hope to see you at our next Digital Health Drinks Night tomorrow, Thursday, April 11th from 5:30 to 8:30 at the Liberty Hotel Bar in downtown Boston with our guest Sean Cheng of Ascension Ventures. And you can find a list of upcoming events at stephenwardell.eventbrite.com, and you can follow me X at Stephen Wardell. And thanks for joining us, and thanks so much, Ron, for joining us today.
Thank you.